My name's Louise and I'm one of the distance learning tutors here at First Intuition. And in this session, we're going to be looking at your audit task 3. So this is task 3. If you're a First Intuition student, that's from Mock 1, of your audit exam. Now, task 3, this is a big one, much bigger than tasks 1 and 2. Task 3 is a written task, so it's worth 25 marks. Which gives you around 37 minutes to complete it. Now, there will be some nice marks you can pick up from multiple choice questions. It won't all be written, as you can see from part A on the screen right now. So you will get to answer some multiple choice, but the big bulk of marks is going to be coming from the written element. Now, this task is mostly based around audit risk, and your 3 areas you should be really familiar with and be able to explain well are your inherent risk, your control risk, and your detection risk. 3 really, really important areas. So we'll answer part A first. We'll do this nice little multiple choice, and then we'll move on to the written task and we'll think more about how to approach that then. So part A tells us it is the 5th of February X6, and you are planning the audit tests on sales and trade receivables of Flying Fish Limited. This is the company throughout this task. They are an established client who are fish wholesalers, selling to large supermarket stores and small retailers. Whilst planning the audit of Flying Fish Limited, identify the working paper needed to meet the following requirements of the external auditor. Okay, really important then that we know which working papers are going to be needed for which area. And they are nice enough to give us a pick list. So our answers are either going to be summary of unadjusted differences, partner review points, or client meeting agenda. 3 very different things. So let's have a look. First one then is to ensure any concerns over the appropriateness of conclusions drawn are answered. So really important then to remember that the audit partner is the person who is ultimately responsible for deciding that final opinion. That is it. The audit partner is ultimately responsible. Okay. So they're going to get all of that evidence that's been gathered and put on file, and they're going to review it. And if there's any points on there that they're not happy with, they may raise points with the other audit team members and ask questions to get everything confirmed before they make their conclusion. Okay. So to ensure any concerns over the appropriateness of conclusions drawn are answered, that's the partner's job. That's the partner review points. Pop that in. Okay. And our second one we have here then is to ensure all outstanding points are discussed with those charged with governance. Okay, so we need to make sure that all those outstanding points, all the things that haven't been confirmed, where conclusions haven't been reached, we need to make sure that they're all discussed, right? So that's going to be in the final meeting that's held with the company directors. And in that meeting, they will be discussing any outstanding evidence that's needed, any potential adjustments that are required. All of those things must be discussed in this meeting so that a final conclusion can be drawn. So to ensure that that happens, we need to have a client meeting agenda. That's not very clear, is it? Let's try that again. Not that that's much better. So client meeting agenda. What's nice about this is I think it's very difficult to get this one wrong with the options that you've been given. So finally, we've got to ensure all errors over a tolerable error are recorded for aggregation. So just remember what that is. So at the end of an audit, all of the errors that we found as auditors are going to be reviewed. We're going to look at the errors individually. Are they material? but we also need to combine them. So we need to aggregate them, okay, to decide what is the impact on the accounts. Is that impact material? Okay, so here, this is where we need our summary of unadjusted differences, because we need to make sure that every single error that we haven't been able to fix, or well, that the directors haven't been able to fix, have been recorded. So summary in the smallest box ever, summary of unadjusted differences. That's 3 nice marks, I would like to think. Okay, now we can move on to the big written element. Students tend to find these written areas quite intimidating in every unit, not specifically in audit, all the way through AAT. Written areas is an area that students aren't keen on. Now, there's some important things, important skills when it comes to written tasks. So the very first thing that I always say is actually read the task first before you start reading the scenario, so that when you read that scenario information, you know what you're actually looking for. Read the task first. Have a look at what you've been given. So in this instance, we have just got some blank boxes to fill in. So the approach, how we approach this task is, well, it's up to us, right? And it's going to be really, really important that we make our answer clear, so that when the examiner comes to mark it, they're not fishing around trying to see, you know, if you've put one massive paragraph, if you've just filled in all of this space in sentences, you haven't put headings, you haven't put clear paragraphs, it's much harder for the examiner to find marks for you, okay? Make it easy for them to give you marks. It's just the way to do things. So clear headings, clear paragraphs. Now, for audit, we must be writing in a way that an audit junior could understand. So somebody with less knowledge than you, could they follow the instructions that you're given in this task? Could they follow your advice? That's what you need to be aiming for. So you must be clear and precise. I'm going to write this down. So you must be clear and precise. Oh. You need to say what needs to be done, how it should be done, and why it should be done. Okay, give that audit junior all the information that they need. And once you've written an answer, go back and read it back to yourself and think, is that clear? Could I follow that if I was an audit junior? Could I have followed that? Okay, so let's have a go. First of all, in part I, we're asked to discuss 3 audit risks that should be considered when planning the audit of sales and trade receivables for flying fish. Okay. Part II, we're asked to explain the audit procedures that should be undertaken for each risk identified in part I. So we're going to be looking at, we've got revenue, trade receivables and irrecoverable debts. We need to find 3 audit risks. We need to discuss them and explain our audit procedures. So quite a few points to hit per risk. So let's have a look. We've been given the extracts of financial statements for the current and the prior year. And we can see we've got December X4 and December X5. And we've been given revenue, trade receivables, and irrecoverable debts. Now, at this point, I would definitely be doing the maths element to this, and I would be wanting to find out our increases or decreases in these figures right now, so that once I start writing my answers, I don't have to keep stopping, picking up my calculator, because you just lose that flow and you could forget where you was. So our revenue then, our revenue has moved from 20,690,700 to 24,058,960. So straight away, I can see what, about 3.5 million, 4 million increase here. That's going to be quite a big increase in revenue in the space of 1 year. So let's just figure out the percentage increase, because that's what we'll use in our answer. So hopefully you're all comfortable with doing your percentage increases. So we'll do our 24,058,960 minus our 20,690,700 from the previous year. That'll give us the difference in a whole number, and times it by 100 should give us a 16% increase. I would consider that to be quite a substantial increase. Hopefully you would agree. In the space of 1 year, 16%. Okay, let's have a look at what else we've got. So trade receivables have gone from 1,133,740 to 1,905,760. Again, a very, very substantial increase here. Without actually doing any math straight away, I can see around an £800,000 increase. An £800,000 increase on 1.1 million is definitely going to be a substantial increase. So let's just put the figures in and find our percentage. So same as what we did before, we're going to do our 1905 760 minus our 1.133 740 to find our difference in a number, and times it by 100 gives us a 68% increase on trade receivables. That is huge. 68% increase on the amount of customers that owe this company money. And that's a lot bigger than the increase in sales or in revenue. Yeah, definitely we can see some risks piling up here, can't we? So let's have a look at our irrecoverable debts. So our irrecoverable debts have gone from 63,240 to 20,590. So our irrecoverable debts written off has actually reduced, and we can see straight away that they've reduced by about a third, which seems strange, seeing as trade receivables and revenue have increased. We would fully expect irrecoverable debts would increase in line with the increase in revenue. So what we want to find out is what are their irrecoverable debts in terms of trade receivables. So what were they in 2004 compared to what they are in 2005? So if I put this down here, let's put it up here so we can see it at the same time. So first of all, for X4 then, we're going to take our irrecoverable debts balance of 63,240. And we're going to divide it by trade receivables. So our 1,133,740 times it by 100. That tells us that in that year, irrecoverable debts were around 6% of our trade receivables balance. Okay, let's have a look at what they are in X5. Same thing. So irrecoverable debts balance of 20,590 divided by trade receivables of 1905,760 times by 100. And this time, we're getting an answer of 1%. So last year, we had debts written off of 6% of trade receivables. This year, only 1%. So there's definitely some risks flagging up here. Are our figures overstated for revenue and trade receivables? Have irrecoverable debts been understated? Because these figures don't necessarily make sense. Okay, there might be some genuine reasons, but as an auditor, we should be looking at this and going, well, it's a bit weird, it's a bit strange that revenue and trade receivables have increased so much. And what's even stranger is that even though they've increased, our irrecoverable debts have decreased. That's not what we would expect. So we'll start with the first risk. We need to discuss an audit risk and then explain the procedures that should be undertaken for each risk. Okay. You need to present this in a way that's very, very clear to your examiner. Now, headings, so simple, but so important. Risk 1, And I'm going to answer part I and part II, both under this risk one. Okay, so let's just put my pen on charge for a second, because I don't know if you've seen it pop up to say that it was running low, but it only takes 30 seconds. Let's just have a think about this then. So we're going to need to say, what is the risk and why do we think there's a risk? So definitely going to start off with the increase in revenue and trade receivables. Now, discussing that risk is worth 9 marks, and we're doing 3 risks. So we should be aiming for 3 marks for per risk on part I. That should guide us on how much we need to write. 1 clear and complete point per mark available, 9 marks available, and 3 risks to discuss. So underneath risk 1 in our first little section, we need 3 clear and complete points. Then in explain the audit procedures, we've got 8 marks there, split across 3. You're looking for 2 or 3 marks per one, because 8 doesn't split equally between 3, obviously. Excuse me. So knowing how many marks are available in written task and for each section is really important, because you use those marks to guide how much you need to write. Now, when I say 1 clear and complete point per mark available, I do not mean 1 sentence. And this is a mistake that students make. It might take you 4, 5, 6, 7 sentences to make a clear and complete point. It's not per sentence. So once you've wrote your idea, sit back, look at it and think, as an examiner, could I give this a mark? And remember, these are level 4 written tasks, okay? A 5, 6 word sentence is not going to be enough to get a mark. An examiner is just not going to give you a mark at level 4 for brief answers. And here we have got a discuss and an explain. So they want detail from you. They're not asking you to identify. If it was identify, brief answer, fine. Discuss and explain, you need to make sure you write enough. Make sure you're adding enough value. The next thing that's really important, I'll just get rid of that, sorry. The next thing that's really important is to make sure that you fully explain your answers. As silly as that may sound, you should be writing your answers, as we said, as if you was writing to an audit junior. That's the example that's given in the book. I'm just plugging in my charger. That's the example that's given in the book. Now, my advice is always to imagine that you're talking to like a 2-year-old. Excuse me. Imagine that you're talking to like a 2-year-old. And anybody that's got a 2-year-old or knows a 2-year-old knows that they'll ask you a question. You give them an answer. Why is the sky blue? Why? 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 They're never happy. They keep asking why. They want more of an explanation from you. When you're writing your answers, sit back. Does it make sense? Have I hit the point? Is there any way that I could ask myself why? So if I've wrote a point and then I ask myself why, could I explain it further? If you could explain it further, then do. Also, don't be afraid to state the obvious. And just so you know, these are tips for any written questions across the board for your AAT exams. Do not be afraid to state the obvious, okay? Stating the obvious will pick you up marks. That's why we've done our percentages. We're going to talk about the actual increases or decreases in the figures. But is it better? Is it worse? You know, state the obvious, because you're writing as if you're talking to somebody who does not have as much knowledge as you. So whilst it might be obvious to you, it might not be obvious to the person who you're writing to. And that's what the examiner wants to see. They want to see that you can explain it in a way that somebody without your knowledge could understand. Okay, pen should be charged now. Sorry. There we go. So frustrating. I need a new one. Well, I need a spare one is what I need. I need a spare one. Okay, so risk 1 then. We're going to go straight in with the increase in revenue and trade receivables. And we did say These are significant increases. Say that. It's obvious, but say it anyway. Now, I'd normally say start underneath your heading, but we are tight for space, so I am going to start next to it. So, there has been a significant increase in sales and trade receivables since last year. Okay. That's fine, but why is it a risk? And this is where we should be putting in our numbers. So what did we say? Our revenue increased by 16%. And trade receivables, sorry, yeah, and trade receivables increased by a whopping, I wouldn't put that word in there, but it's true, increased by 68%. Okay, so we've explained what in the statements has flagged to us that there's a risk. Now we need to say what could the risk actually be? And I would definitely go with the risk is that they're overstated, because that's what we're expecting here. So these increases suggest there is a risk. Oh, the figures have been overstated. Okay, so 3 marks there. Now we need to go into our audit procedures. So our part II. Another heading, make it clear. Show the examiner what you're answering. So audit procedures. So what audit procedures do we need to do if we think that sales and trade receivables have been overstated? Well, the easiest way to check this really is to speak to the customers and see, have these sales actually been made? Are there amounts outstanding? And if so, how much? And see if the customer's records match the client's records. And the best way to do that is to do our receivable circulation. Very, very big words for a very simple process. Okay. So audit procedures, we'll go with perform, receivables, circulation, using a sample. We wouldn't do all of the customer balances, would we? So we'd say use a sample of customer balances. We're going to look at samples in a minute. So use a sample of customer balances and obtain direct, third party confirmation of existence. So does the sale actually exist? Did it happen? And the value of the balance owing to trade receivables. Okay, so there we go. We're testing existence. So did these sales actually happen? And if they did, do the actual figures match up? So have the customers paid us, or do they still owe us that amount of money that's showing on the statements? So that's one suggestion. The next thing we could do is actually compare the trade receivables collection period from last year to this year. If there is a significant difference in that trade receivables collection period, that is going to flag up to us that sales may be being made, but for some reason we are not collecting the money. Customer is not collecting the money, and we'd need to know why not. So compare trade receivables collection period from X5 or from X4 to X5. If there are any significant differences, any significant fluctuations, these need to be investigated. Okay, so that's two procedures. Our third thing that we would actually need to do is speak to management, because there could very well be a perfectly acceptable explanation for this increase in sales. Maybe a competitor's gone bust, and now we're the only person in the local market who can provide this particular product, which is fish. So that would be strange, but it depends on what the product is. Maybe there's some massive trend on TikTok. We know that massively increases sales, it increases demand for products. So it would always depend on the actual product. This is fish. What could increase demand for fish? Maybe the sun's out, people want fish and chips on the beach. There could be a really good, really acceptable explanation, but we won't know unless we speak to management. So speak with management. To inquire on the reasons for these increases. Now, what's really important in this unit, what's really important as an auditor, is that you understand that if we speak with management and they give us what seems like a really appropriate, really acceptable answer, we still actually need to prove that their answer is okay. We need to be able to support this with facts and figures, right? We can't just say, oh, wow, the manager said this, so we believe them and that was that. That's not the job or role, I was trying to say both, of an auditor. So once we've spoken with management, we need to perform analytical procedures to support any explanations given. So I've used up all the space that I was given for risk one, so I'm gonna get a different piece of paper, a scrap paper. Go away. And I'm going to have to do the rest over here because unfortunately, as you can see, we've run out of space and there was no way I was going to fit 3 risks into that one page. Okay, so that's risk 1. We've answered part I and II. So now let's move on to risk 2. Make sure we've got our heading. And for risk 2, well, let's just go back and have a look. So we've said about maybe sales have been overstated and that's why our revenue figure's so high. It could also be that sales have been included in the wrong period, whether that's a deliberate error, whether the company were trying to make their sales look higher, or whether there's actually just been an error with a cut-off period. That's what we'd need to find out. So that's what we'll go with for risk 2. So as mentioned above, there's been a significant increase in sales. And this could mean, or this could be due sales being included in the wrong period. Also known as cut-off errors. Okay, then on to our procedures. So new heading, audit procedures. What would we need to do here to find out if there's been some cut-off errors, whether they're purposeful, is that a word? Whether they were done on purpose or not? Well, the first thing then is to actually look at the invoices and see the dates of the invoices. So we'd use a sample again. We wouldn't check every single invoice. So we'd select a sample of invoices. And then we would need to compare this to the dispatch note to make sure that the invoice has been dated correctly as per the dispatch note for the order. So it could be that invoices have been raised 3 days after the year end. But actually, due to the date of dispatch, they should have fell into a different period. So that's going to be our first one then. So we're going to select a sample of invoices. Select a sample of sales invoices. Let's be very specific. Select a sample of sales invoices. From throughout the year, because we want to check what's the typical date. So we want to look at generally throughout the year, what is the invoice date in comparison to the dispatch date? So select a sample sales invoices from throughout the year. Yeah. And then inspect the relevant dispatch note. So what are we checking for here? We're checking that the invoice has been recorded on the correct side of year end. Okay, so a check should be done to ensure the invoice was recorded the correct side of year end. Because it very well could be a massive, massive order came in X4, but for some reason we have recorded that order in X5, massively affecting that sales figure. And that could be our answer to our question. So the reason that we check sales invoices from throughout the year is to see what is standard procedure between the date of dispatch and then how long until the invoice is raised. If generally, say it's 3 days between dispatch note and invoice being raised. But for some reason at the year end, there's a dispatch note and the invoice wasn't raised for 3 weeks, we might think, okay, that seems a little bit fishy. Excuse the pun. I can't believe I just said that. That might be a little bit fishy. And it might be that they delayed raising that invoice so that they could inflate that sales figure for this year. So that's what we're looking for. Okay. And we do need to check this with our cut-off testing for inventory. So this should also be matched up with cut-off testing for inventory. Okay, and that's risk 2 done. And we can now move on to risk 3. So risk 3 is definitely going to be looking at these irrecoverable debts, right? Our irrecoverable debts have decreased by 1/3, whilst trade receivables and revenue have increased significantly. So there's definitely a risk here. What is the risk though? Well, the risk here is that in trade receivables, we have got some bad debts, or the customer, the client has got some bad debts that they haven't written off. Why would they do that? Well, to increase their sales and their trade receivables figures and to make themselves look better than they actually are financially. So, risk 3. Despite an increase in sales and trade receivables, irrecoverable debts have decreased from 6% in X4 to 1% in X5. So be specific. The risk here is that our irrecoverable debts sitting in the trade receivables balance. So again, we've said what the risk is and what has flagged this risk up to us. Well, it's the decrease from 6% to 1% that's flagged the risk, and the risk is. Be really, really clear. So our audit procedures, what do we need to do about this risk? Again, with the headings, really, really important and takes you seconds. It also means with these headings that when you go back to mark your own work, just to check, you can clearly see that you've answered every section. Whereas if it was all muddled up in one big messy paragraph, even you wouldn't be able to tell. You know what it's like 30 minutes after you started writing, you can't remember what you put 15 minutes ago. Okay, so very first thing to do is to look at the age receivables report. Okay, we're looking at debts. Look at the age receivables report. So inspect an aged receivables report. What are we looking for? And identify any old or overdue amounts. If you go and look at the age receivables reports and you know that this business generally gives credit terms of 30 days and there are amounts on there that are 6 months old, we know that this customer should have wrote off those debts. They should have wrote them off, but they are sitting in trade receivables. So that's definitely an issue. Okay. What we would do, the next step is for any of these amounts, speak with the credit controller because it's their job. So if there was only, let's say, one overdue amount, we may speak to the credit controller and they may say, actually, do you know what? This client's just gone through a merger, or they might just have, again, a valid explanation. But that's why we need to speak to them. Okay, we need to actually speak to them to find out what they say. So discuss with the credit controller any amounts overdue or any old or overdue amounts. Conversations need to be had. It's our job as the auditor to ask these questions. Okay, so we're going to need to ask or inquire about the likelihood of receiving payment or of recovery. There we go. Okay. Finally, we need to make inquiries of client staff regarding any unresolved disputes over payment with customers. Okay, so that would be our last one. So make inquiries of client staff, the rest of the accounts team, the sales team, regarding any unsolved disputes over payments with customers. So it may be that a customer's saying they didn't receive an order, but we know they did. And that's why they've not paid yet. That's why it's still sitting in the trade receivables, even though it's overdue and we've not written it off because we know that it's owed to us. We are just maybe having some trouble. The client even is just maybe having some trouble proving that. So maybe the client's actually taking his customer to court to prove it. So it's still okay to be sat in the trade receivables, even though it's old, because we're not expecting to have to write it off. Okay. So that's your written area done. And then we just get a couple more nice multiple choice tasks. So first of all, as auditors, we use judgment to calculate a materiality figure for Flying Fish Limited. Be really clear on materiality. So what we're thinking of here is the financial statements, they are prepared and they are used by decision makers. So maybe external stakeholders, the bank, investors. Yeah. If an investor was trying to make a decision on whether to invest more money into Flying Fish and a particular transaction was missing from their accounts, would entering that transaction affect the decision that shareholder makes on whether to invest money? And that's what we're thinking of with materiality. So let's say corner shop down the road, turnover of £300,000 a year. And they have an invoice for £50,000 that they've conveniently left off their financial statements. Well, that's going to make a very big difference, right? That's really going to impact the results on their financial statements. Then let's think of Tesco's. Turnover of hundreds of millions of pounds a year. That same £50,000 invoice is not going to affect the materiality of Tesco's financial statements. It is not going to matter to a decision maker whether that £50,000 invoice is on there or not. There is always the other angle that you need to be careful of with materiality, because it's not just about money. We also have the qualitative information, the qualitative nature. So remember, if let's say the company has a £50,000 car and they sell it to the director for £2. Whilst that's only if there's a £50,000 car, multi-million pound company, that £50,000 in money terms, in quantitative terms, is not material. However, if you was going to invest in that business, you'd probably want to know that the company sells things to its director way undervalued. So when you think about materiality, this is the mindset to have. So which items will be considered in establishing whether an item is material? And we are asked to select two. So the number of shareholders who may read the audit report. Well, I really hope that you don't think that that's an answer. Its value in relation to revenue and assets in the draft financial statements. Of course, that is our materiality to a T, isn't it? Value in relation to revenue and assets. Next, we've got the length of time available for audit work to be performed. Yet these things are not materiality. And then the qualitative nature of the information to the user of the accounts. Of course, will the user care? Will it change their decision? Well, if I'm looking at investing in a business and I find out that they are regularly selling £50,000 cars to the directors for £2, that might change my decision. I might not want to invest in a business that does that, because it's all money to the business, isn't it? Even if £49,998 isn't that much in comparison to the hundreds of millions, if it's something that they do regularly, it will start to have an impact. And the last little question then is about sampling. So it says we can use a number of techniques when auditing Flying Fish Limited, which can be used to determine which items are selected in a sample. Match the sampling technique to the descriptions below. So we've got our random number sampling, interval sampling, money unit, haphazard, and it says interval again. Oops. Okay, it's always nice when there's a pick list. So let's have a look. Match the sampling technique to the description. So the auditor selects every customer account beginning with B. Well, yeah, every customer account beginning with B is going to be at interval sampling. So at intervals of every customer account beginning with B. One people are generally very familiar with. And the next one, the auditor generates a sample using a computer program where each item has an even chance of selection. So we're using a computer program and each item has an even chance of selection. Well, it's not going to be random. Sorry, it is random. It's not going to be interval. It's certainly not going to be money or haphazard. So it must be random. So random number sampling. And finally, the auditor selects every balance that takes a cumulative total over £20,000. Well, of course, it's money, isn't it? There's a nice big clue here. This £20,000 screams to us that this is money unit sampling. I think if you read each of these individually and look at the example, at the pick list that you've been given, they're generally not bad questions, but just don't rush. people get these things wrong because they've rushed and they've not read it properly. So just take a second, okay? So money unit sampling. Okay, that's our task 3. I did say it is a big task. There's lots of marks available. Quite nice that the written element is bookended with some multiple choice questions, but it's just take your time, read the question properly, make sure you understand what they are asking for, check for, identify, discuss, explain, and use the mark allocation to help guide you on how much you need to write. Okay. And always use headings, clear paragraphs to make sure that you can see that you are writing enough and that you are answering all parts of the question. Because this is where students fall down in tasks like this. Let's go to the top. We've got I and II. And generally, students will answer one or the other, and then they're losing loads of marks because you just simply haven't answered both parts of the question. That's what you need to be really careful of here. Okay, I hope you find that useful, and we're back with task 4.